Don't be Mr. Taxed to the Max. Be Mrs. Iva Lot More. In this educational episode, I'm going to talk about how IUL can generate 100% more in net spendable income during retirement. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for nearly 5 decades, helping thousands of people prepare for a comfortable retirement so that they will not outlive their money. So years ago, when I was on the air in my radio studio, just on the spur of the moment, I came up with this Mr. Tax to the Max versus Mrs. Iva Lot More. And what I mean is this. So many times, Americans are told to continue to defer paying tax on their IRAs or 401ks if they don't need the money after they're age 59 and a half. Now, what can you do after age 59 and a half if you have money in tax-deferred IRAs or 401ks? You can access that money without a 10% penalty. If you touch that money before age 59 and a half, there's a 10% penalty on top of the tax. But you're not saving tax. You're just going to postpone it, okay? You're going to delay. You're going to procrastinate. Now, I've never procrastinated anything where it turned out better. But yet, so many people, if they don't need the money, they get, I think, duped into continuing to defer and procrastinate, taking money out of their IRAs or 401ks if they don't need the money. And, you know, most CPAs and tax attorneys, they go, well, if you don't need the money, leave it in there and keep deferring. Or maybe their client says, well, in order to pay the least amount of tax this year, what should I do? And if it's just that year, which is myopic, very short-sighted, the accountant goes, oh, well, then don't take out any money. Wait until you're age 72. Now, what happens if you don't start taking money out of IRAs or 401ks at age 72? The penalty on what you should have pulled out each year is 50%. And so these are called RMDs, required minimum distributions. See, the government has been counting on this tax revenue. They actually budget their spending based upon how many Americans are turning age 72 and how much money they have. They know everything. And so if you're 72 and you have, let's say, $1 million accumulated in IRAs or 401ks, and your life expectancy is 20 years, they want you to pull out 1/20th at age 72, $50,000. If you don't pull out $50,000 and pay tax on that, the penalty is $25,000, 50% of the $50,000, and you will have to pay tax on the whole 50. See, they'll take out 85% of your money because they are planning on that tax revenue. So that's called an RMD. Now, a lot of times CPAs will say, well, if you want to pay the least amount of tax this year at age 72 and then 73 and age 74, take out the RMD. That's very myopic. I created a software program years ago that would show people the darkness of the night if they did that. If you continue to take RMDs and continuing to let your IRAs and 401ks continue to grow and defer and letting the government have a permanent tax lien and be your partner throughout the rest of your life to your life expectancy, you keep paying RMDs because the next year, if your life expectancy is 19 years, you have to pull 1/19th, then 1/18th, 1/17th. You have to keep pulling out more and more money. If you keep doing that throughout your life expectancy and then your spouse's life expectancy, and then you leave behind money to your heirs, they have to now get the money out and pay the tax within 10 years. They cannot wait until they retire necessarily. And so I added up all of the taxes people will pay if they continue to defer, and people are flabbergasted. Most people, if they had at age 60, $1 million nest egg, and they took RMDs starting 10 years later or 12 years later at age 72, they're shocked because they'll pay more than $1 million in tax by stringing it up because they keep deferring and it's like the best savings bond the government ever came up with for themselves, okay? And so it's not the smartest way to go. It's very myopic. So years ago, I would show people the brightness of the day versus the darkness of the night if they did that by doing a strategic rollout. Now, that's not a rollover. A rollover is going from the frying pan to the fire. That's taking money in 401ks at age 60 or 65 and rolling that over into IRAs and continuing to make that mistake, deferring till age 72 and taking RMDs. You're not saving tax, you're actually increasing the tax. So my program would show people, well, what if you roll the money out, starting at age 60, and got the taxes over and done with while your account values are lower and taxes are lower, because most people believe that taxes in the future will likely be higher because of irresponsible government spending and the printing of money and so forth. And so you get the taxes over and done with while your account value is lower. And then you reposition the net after-tax money into something that's going to be tax-free from now on. And my favorite vehicle is a max-funded indexed universal life insurance contract, because that allows you to accumulate your money now tax-free, and then you can access the money tax-free. But your rate of return on IUL is usually double to triple that over where most people have their IRAs or 401ks, but it's just totally tax-free. So you can increase your rate of return and increase your spendable income because it's tax-free. I'll give you some examples here in just a moment. And so that's called a strategic rollout. One of the reasons why I like max-funded IUL is because at the end of the day, when you finally pass away, the IUL blossoms. It transfers income tax-free and increases in value, which means if I died in an accident tomorrow, I'm 70, every million I would have in my IUL portfolio would double to about 2 million and transfer tax-free. So at the end of the day, you actually get reimbursed for some or all of the tax that you incurred during the rollout process. So you're not out anything. Well, let's get back to this little example, Mr. Tax to the Max versus Iva Lot More. So on the radio and in this newspaper article that I wrote, it showed a 60-year-old male that I named Taxed to the Max. And he had $500,000 accumulated in IRAs or 401ks, and he's earning 7.2%. Now, rule of 72, that $500,000 doubles to $1 million in 10 years. So let's say he did that at age 60, 62, and 10 years later at age 72, he now has $1 million. And so now he starts pulling out an income out of that, and he has to pay tax. So I calculated the amount of tax that Mr. Tax to the Max ends up paying during his lifetime, and he ends up paying tax through the nose the rest of his life. And I calculate that, and then I compare it to Mrs. Iva Lot More. Now, he's going to have to pay taxes totaling $580,000. He leaves it behind to his spouse and his kids, and he ends up paying over $1 million in tax on that money that grew to $1 million. People don't even add up the negative impact of taxes by stringing it out, stretching it out. Now, Mrs. Iva Lot More, she has the same $500,000 at age 60, but she's smarter. She performs one of these strategic rollouts. And so she takes out 20%, $100,000 a year out of her IRAs or 401ks and pays tax on that. She pays $30,000 in a 30% tax bracket on the $100,000 she rolls out each year. And so after 5 years, she has taken care of her taxes on those accounts. She paid $150,000 in tax. Now that was continuing to grow, but she ends up being able to generate on that account a total of $86,000 of tax-free income without depleting principal the rest of her life. And when she dies, she leaves behind more than $600,000 tax-free, whereas Mr. Tax to the Max, he pays taxes the rest of his life, and when he dies, his kids and his spouse end up paying tax on that. It is horrible. She ends up with twice the net spendable income, about $86,000 compared to his after-tax income of about $43,000. She has twice the income. We do this all the time, and she leaves behind 50 to 100% more when she passes away compared to Tax to the Max. We do this all the time. So I had a husband and wife, both were school teachers years ago. And when they came to me at age 60, they had $250,000 in their 403Bs and their 401Ks, their TSAs. Their advisor was saying, oh, if you don't need the money, keep postponing to age 70 and a half. It used to be 70 and a half when you had to start taking RMDs. I calculated that. They were shocked when I showed them they were going to pay at least $250,000 in tax if they strung it out. And so they performed a strategic rollout. And by getting the taxes over and done with in 5 years, from age 60 to 65, we pulled out $60,000 a year, paid tax of $12,500 a year times 5 years. They paid $60,000 in tax instead of the $250,000 by stringing it out. Now, when I showed them that, then I was able to also show them some tax strategies to resurrect deductions they'd been killing by paying off their real estate the wrong way. And so we were able to refinance that, resurrect some deductions. And long story short, I reduced the tax liability by creating new deductions on the rollout to where I got the taxes down to $20,000. And then they also resurrected some deductions on a cabin they own, and I eliminated the taxes down to zero. So we were able to get their money out of those IRAs or 401ks over a 5-year period, totally tax-free. They ended up with $360,000, and that was totally tax-free. And then they were able to enjoy double the net spendable income over what they would have had they continued to defer. We do this all the time. I had a real estate guru. He owned a bunch of properties. When he came to me, he had $600,000 in his IRAs and 401ks. His wife had just passed away. His advisor told him to take just 4% out. 4% on $600,000 was only $24,000 a year. After tax, $16,000. Pretty pathetic. That's called the 4% rule. We did a strategic rollout where we repositioned his money out of that $600,000. It grew actually to $750,000, and we pulled out $150,000 a year each year for 5 years. Even worst case scenario, he would have paid a third in tax, $50,000 each year for 5 years. He would have netted $500,000, and that $500,000 in an IUL would have generated $40,000 to $50,000 a year of tax-free income compared to the $16,000 after-tax money in his IRAs or 401ks. But we were able to offset the tax, and we actually ended up with $750,000 by resurrecting deductions on his rental properties. He ended up with $750,000 at 8% payouts. That was $60,000 a year of tax-free income. He was actually earning 10%. He was able to enjoy $75,000 a year of tax-free income versus the $16,000 he was going to get out of his IRAs or 401ks following his accountant and his advisor's advice. We do this all the time. We quadrupled his net spendable income. We had another couple, both husband and wife were physicians. They accumulated they had $4.6 million in yet to be taxed IRAs or 401ks. Their advisor said, well, they can afford to pay $2.6 million in tax, Mr. Andrew, because I calculated they're going to pay $2.6 million of unnecessary tax. I said, well, let's ask them. I said, I can't save you $2.6 million, but I could save you $1.2 million. Would you like to do that? They go, yes. So I saved them $1.2 million of tax. They funded an IUL policy that has been generated $100,000 a year of tax-free income for their kids and grandkids into perpetuity for all kinds of goals because they don't need the money. We do this all the time. So if you want to learn how to generate double, triple, quadruple the income and be like Mrs. Iva Lot More, learn how you can do this. I would love to show you how to accumulate, access, and transfer your money totally income tax free. I want to give you a copy of my most recent best-selling book called The Laser Fund. This is what all of these people I've been talking about, Mrs. Iva Lot More, uses. Now, this is a 300-page book. It's actually 2 books in one. This side is about 200 pages, 14 chapters, that has all the charts and graphs and explanations if you're a left brain learner. If you're more of a right brain learner, you learn by stories and examples. You flip the book over to this one, the orange covered side, which is about 100 pages, 12 chapters with 62 actual client stories. And so I would recommend you read both of these, use both your right brain and left brain. But here's how you claim your free copy. You don't have to go on Amazon and pay $20 for it, plus shipping and handling. Simply go to laserfund, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you while you're in there claiming your free copy. If you like to listen and learn or watch and learn, there's options there for audio and video. Check out the free webinars we teach on a regular basis. There's no charge for those. And you can even schedule an appointment with an IUL specialist that will help you understand how to structure an IUL correctly to accomplish what I'm talking about so that you can have double, triple, or even quadruple the net spendable income over money trapped in an IRA or 401k.